Hello, again, welcome and thank you for joining us this afternoon for the Greater Milwaukee Foundation's first quarter investor briefing. My name is Joseph Brooks, and I serve as the Foundation's Senior Director for Donor Services. We've got a big group today, and on behalf of all my Foundation colleagues, we're grateful for your partnership with us here at the GMF and for your time on Zoom today. So we're just about to get started, but one more friendly reminder, we've got a Q&A button at the bottom of your screen, and we would love to hear from you all with questions and things that you might like to offer for our conversation following Mike's presentation. So feel free to log those there in the Q&A button as we move along this afternoon rather. So to get us started, I am pleased to introduce Kristen Meckimson, the GMF's Vice President for Development and Philanthropic Services. So Kristen, passing to you.
Thank you, Joseph. Good morning and welcome to our first investor briefing of 2023. Thank you for joining us today. It's always a pleasure to reconnect with our closest partners who walk shoulder to shoulder with us as champions for philanthropy. We're grateful for your trust in us and for the opportunity to brief you on our investment strategy in the current market. Before I introduce Mike Miller, I'd like to review our 2022 results and impact, which despite the volatility and challenge that the market brought, we were able to serve our community in significant ways alongside our philanthropic partners. We believe our greatest strength at the Greater Milwaukee Foundation is our network of community partners and our ability to bring all voices to the table to deploy resources, both to meet the moment and to invest in long-term generational change. As is our custom in the first quarter of the year, I'll share figures that represent our collective impact in 2022. This is one way to understand how we're facilitating philanthropy to build a vibrant and equitable community. What's most important is what is behind these numbers: caring donors engaged in meaningful giving and grant making, nonprofit colleagues who are focused on making life better for all of us in Greater Milwaukee, and neighborhood residents who are bringing their lived experiences and voices to determine where dollars can have the greatest impact. We are grateful to all of you who entrust us with your time, talent, treasure, and ties, so together we can build a Milwaukee for all. In terms of metrics, here is an overview of the Foundation's preliminary 2022 results. We'll start with dollars coming into the Foundation. Cash totals equals $63.2 million. This represents gifts from donors who have started new funds, as well as added to current funds, and also bequest dollars from those who have passed and for whom GMF is stewarding their legacy. Promise totals stand at $27 million. This represents future dollars from donors who have generously included the Foundation in their estate plans and have shared with us a good faith estimate of what they believe that gift will be. We track these promises as a way to inform our long-term planning efforts so we can best steward these donors and their gifts. That brings us to a grand total of over $90 million. As for dollars distributed from the Foundation in 2022, grants awarded totaled $81.2 million. That is $71.8 million in donor-directed grants and $9.4 million in board-directed grants. This is astounding. Let's take that in. $81.2 million put into the community during a tumultuous year impacted by inflation and market volatility. That is worth celebrating. What can we learn from last year as we prepare for the year ahead? I'll offer a few observations. First is that market conditions have influenced giving. Donors have been thoughtful about the timing of their gifts, and we've observed that donors have been thinking differently about how they give. For example, we've seen an increase in donors who are age eligible direct their required minimum distributions from their IRAs to funds that may accept such qualified charitable distributions. This minimizes donors' tax liability while fulfilling their philanthropic goals. We're also in conversation with donors who have other assets like art and real estate, and are working with their professional advisors on donating these special assets to the foundation in service of their goals. Second, as in the past and as 2022's numbers bear out, giving increased when community need increased. Even as we all grappled with inflation, our donors continued to give, demonstrating your care for Milwaukee and how much you value the work of our nonprofit organizations. Third, our longevity as an organization and our endowment model and investment philosophy work. We're built for the long haul, and while we are not immune to market fluctuations, we are better able to absorb them, and our business model ensures that together we can still be there for the community when the community needs us the most. Economic change is hard on the nonprofit community and the people they serve, and our grant making provided consistent support. Finally, 2022 reaffirmed our belief that we are greater together. The Greater Together campaign, launched publicly last March, has considerable momentum. We look forward to sharing an update in the coming month in honor of the 1-year anniversary of the launch and the initial impact of our collective investment in these strategic priorities. In the meantime, we are energized by the many donors who recognize the deep change we can make together, especially in the fundamental areas of our lives: early childhood care and education, economic opportunity, health equity, and housing security. And as we anticipate what's to come in 2023 and continue to advance our ambitious plans, we invite you to continue reimagining philanthropy with us. Join us in learning and investing together, thinking bigger, and acting bolder. Transformational change, what Milwaukee needs, will take all of us. We remain grateful for all the ways you contribute to our community. We couldn't do this without you, and we are here for you. Please reach out to your contact at the foundation to learn more and advance your philanthropic plans. And now I'm happy to welcome Mike Miller to the conversation for our first quarter market update and report on investment strategies. Take it away, Mike.
Great. Thank you, Kristen. A real honor to be here with you all. As always, it's wonderful to see you. Well, I don't see you, but I hope to see you soon, many of you. And so we're going to dive right in with a report that is, I think, generally optimistic and certainly we're pleased with some of the long-term outcomes that you may have seen. So if we advance to the next slide, we'll get right down to business. So Kristen mentioned the word inflation several times. And so I just want to highlight these bars. If you take a look, the gray bars are the consumer price index, i.e. inflation plus spending rate of the foundation over time. And you can see what a really challenging year 2022 was. This is data ending January 31st, 2023, but the 1-year number captures predominantly 2022, as you know. And you can see that very large bar is the inflation plus a premium for the spend rate that goes on. And as a reminder, over time, while we look at a lot of benchmarks, and I'll dive into these in a moment, while over time, we want to beat our benchmarks and think it's essential that we do so, not just in the past, but also in the future. What we're really here to do is all the work that Kristen just touched on, frankly, that you're all doing and that others have done in the community and the foundation does to support a stronger Milwaukee and the region as a whole. And what you'll see is that we're trying to outperform the CPI plus spending. I'm going to come back to that in a minute. That's everything we do is focused on that. And there's always a price for anything that you do that's difficult. And so we'll talk about some of the prices in a minute. So the blue bars that you're looking at are the foundation's returns net of investment management fees. January actually gives a nice roll forward because the last year the portfolio was down about 16% in 2022. And you can see that just dropping off a month and adding a month, which doesn't sound like a big deal, has reduced that to a 7.5% decline. So it's nice to see a very strong return in January. We're also dropping off a weak return from January of last year. The red bars are a simple blend of 70% global stocks, 30% bonds. That's our steady state risk measure, essentially, where we think that's about the risk we're taking in the portfolio over time. And then the green bars are what we call the custom market benchmark, which many of you have heard about before. And what that is essentially an index portfolio that mimics the foundation's strategic asset mix that the investment committee recommends each year to the board for approval. And one of the things that the committee actually met earlier today, and so I'm pleased to give you an update on what their discussions were like around the strategic asset mix in a moment. So a couple of things to point out. One is you can see we did not have a great year relative to the green bar. That's the first set of columns you see there. The portfolio is down. It's not down as much as the 70-30 mix, but it was down more than the green bar. So we're obviously not happy with that. But I want to make a very big statement here, which is that we're very focused on these long-term outcomes. And some of the things that hurt us last year, we think are really great things for the next few years. And so we're willing to tolerate some pain in reason, I hope, and in pursuit of strong long-term returns. So if you can kind of glance across the page, there are two other things that are very much worth looking at here. The first is that for 3 years, 5 years, 7 years, 10 years, and 20 years, the blue bar is outperforming the red and the green bar. And those numbers don't look like much. We'll come back to that in a minute, but it's outperforming by meaningful margins that, especially when you compound them over time, are a big deal. But perhaps the thing that we're most proud of is if you look at 7 years, 10 years, and 20 years, there's slightly different versions of the same story, which is that the green and the red bars are not keeping up with inflation plus the spending rate. Whereas with the exception of 10 years, where we're very close, the portfolio is outperforming those objectives. So this is ultimately what we really need to do. We need to overcome whatever headwinds the markets give us and those benchmarks the red and the green bars show us in terms of achieving our real purpose here. And when we do that and we change essentially a shortcoming into a premium, we're very, very pleased with that. So I hope you share our happiness with that outcome. And you can see, again, those blue bars outperforming the gray bars over most of those periods once you get out to 7 years and longer. And that's a very, very important part of the outcome and one of the reasons we invest the capital the way we do. So we turn to the next slide. So I mentioned a minute ago that it's hard to see in the graph before what the meaning is of some of these premiums. And the reason it's hard to see is the table you saw before, the chart you saw before, is basically per year. So what we're doing here is we're compounding the numbers. You can see the cumulative impact of multi-year periods. So for example, a short-term period where you outperform is nice, but it doesn't mean anything compared to a long-term period of outperformance, because that's where you get the benefit of compounding, So a couple of things this chart shows you. The first is those relatively small premiums you saw before, particularly for 20 years, look a lot larger here. And you can see the portfolio essentially has gained about 375% cumulatively, which is well above that gray bar, and also significantly above the custom benchmark or the 70-30 mix. Again, and actually the 70-30 mix, excuse me, but not of market losses and market volatility. They are important. But you can also see here how relatively insignificant the recent losses look like compared to these longer term outcomes of positive returns. So we're very focused on this trade-off that we sometimes need to make. And we're particularly at a period in time right now where the trade-off is very stark. A lot of us suffer from a little bit of bear market psychology right now, which is after taking big losses, very easy to become overly focused on those losses as opposed to maybe what the opportunities are looking forward to get back to big returns and big gains. And so we're focused on getting that balance right at the foundation. So we advance to the next slide. So one more way of thinking about performance here, which is how have we done compared to other endowments and foundations? Now here you get to see, I'm changing the time period on you a little bit. We're going back to the end of 2022. And the reason is, we like the 2023 figures better, so I'm sure you do too. There's no universe data on a monthly basis. It's quarterly, so we had to go back. So this is the end of 2022, and we're comparing the foundation's returns to the Investmetrics endowment and foundation median. And that's a big universe. It's about 1,000 endowments and foundations. So it's a very good sample. And there's some very small ones out there, some very large ones in that group. The median, for those who don't do statistics all day, is the middle point of the distribution. So half of the endowments and foundations did better than the median and half did worse. So that's what you see in the comparison underneath. And now with the exception of 1 year, where we are behind the median, you can see that the portfolio has outperformed that median by reasonably solid margins over all these other periods of time, despite a weak, what we call weak endpoint, which is the last year. The gray bar in the middle of the page that you see is what the quartile rankings look like. So this is another way of a little more nuanced way of breaking down what that median number was. So first quartile means you're in the top 25%. Second quartile means you're above the median, but not the top 25. Third is below the median, but not the bottom quartile, which is fourth, which is, you see, we have one data point here. Now, before anybody gets too worried about a fourth quartile outcome, obviously, I prefer not to show you one ever. However, what I will tell you is this, is we have been in the fourth quartile for short periods of time before. It tends to happen in difficult market conditions because we generally have a very long-term view and we tolerate volatility, sometimes even lean into it. And so we sometimes will have a weak year here and there. But I emphasize that even when you put that weak year into the data, even the 3-year number remains top quartile. And out to 20 years, we're actually the top 10% of all endowments and foundations in the country. So we feel very good about this. I would love this to be firsts across the page, but in the real world, that's not something we can actually do, particularly because I'm going to come back to a bit of a Wayne Gretzky analogy a few times in this presentation, which is that sometimes you need to skate to where the puck is going to be. And that's not necessarily where everybody else is. And sometimes you don't get there at exactly the right time. That's one of the things that's affected our 1-year numbers you can see here. But all in all, very proud of the long-term record, which contributes to the outcomes before. And I would also note one more last thing. The median return over 20 years has not been good enough to keep up with CPI plus spending. So that premium you see here and that top 10% outcome is what was necessary to deliver the kind of premium the return that you saw earlier. And very, very important that we continue to work to repeat that outcome. So we'll switch up to the next slide. So short-term versus long-term, I love to hide in the world of long-term, not because it's convenient for us, but because that's how we think. And that's the decisions we make are very much oriented towards that kind of thing happening. But at the same time, this is a quarterly call. I'm sure you all look at your materials at least quarterly, and you have a right to feel comfortable and confident in what we're doing. So what we're trying to do here is give you a little bit of sense of the consistency of the pool's returns over time. So this is a little bit of a complicated looking graph, but what this basically shows you is on a rolling 3-year basis, how did the pool do compared to its benchmark? So those green bars in the slides before that you've seen. So this is the blue compared to the green. And the spreads you see, so when the blue bars on this chart are above 0, that means the portfolio, again, net of investment management fees, is outperforming its benchmark on a 3-year basis. And what you can see here is that for the most part, there's a couple of things we're very excited about. One is that it outperforms the vast majority of the time. So that's really good news. That shows that we weren't just lucky to have one good year here or there. The second thing you can see is when it does suffer and struggle and underperform, those periods of underperformance tend to be quite small. You can see pretty much the worst case is about a 2% cumulative. So that's not per year, that's over the whole 3 years, but 2% cumulative level of underperformance is the worst we've had. And the best we've had is really about 10%. That was back in the late 90s and the bursting of the TMT bubble in the early 2000s. So we're very proud of the high batting average. We're very proud of the fact there's a really significant positive skew here. So when we do well, we do a lot better than when we do poorly. And that's also how you get back to top quartile, top decile returns and beating the benchmarks over time. So again, this is a really good picture of how the portfolio's performance has managed to move the way it has over time. And one of my quasi-optimistic notes is that the market setup today for us, it doesn't get much better than this, not because it's easy, but in fact, because it's not easy. And the underwriting our managers do, the quality of the businesses they own, the extremely low prices they're paying for them, especially compared to the indexes, which do not have low prices today, is just one of the great setups. I would not be surprised in the years ahead that we challenge those premiums of the past, back to 20 years ago, when we had the biggest premiums we've had in the history of this portfolio. Not a promise, but a hope. Let's put it this way. I tend to convert to a fact. So we'll go to the next slide. Our philosophy is very simple. Consistency is a word that we would love to achieve. We're not perfect, as you saw in the last slide, but we need to have a strategy that we can execute. So you have a fantastic investment committee here at the Community Foundation. I mean, truly fantastic. What impresses me most about it is it's got a healthy level of change and turnover. So it's not the same people all the time. But one of the fears I have in other communities to a larger extent is once you get great people, you almost don't want them to go because it's very hard to replace great people. Somehow the foundation, you have a very deep well of really talented investors in your community and Milwaukee in general. And this deep well of people is getting circulated through the committee in a very responsible way. And what that allows us to do is to really execute this strategy consistently over all of these years. And that's the beautiful thing about it. With that said, we don't want to make this too hard for anybody. No offense to my bosses on the investment committee, but this cannot be a strategy built on being a genius. That is not a strategy. That is going to fail. Nobody's really that much of a genius. So the fact is we need to make this simple. And so there's 3 simple rules that we have here. Rule 1 is establish a strategic mix that is expected to achieve long-term objectives. So in bear markets, there's a temptation to get more defensive. And the reason you don't want to do that is because it usually gets in the way of your long-term outcomes. It makes you feel better about the here and now, but does not help later on down the road. And one of the things I frequently say to you, always I used to when we were in person, is I don't think anybody really cares if Mike Miller or the investment committee members sleep well at night. All we care about is generating the returns. And those of you who have been so generous with your funds over the years to this foundation and the philanthropy you care about, nobody cares if we sleep at night. So we can't be worried about that. Second point, no short-term forecasting. So this morning, the committee I mentioned earlier met and discussed about the strategic mix. There wasn't a single comment in that meeting about where will the S&P be later this year? Will interest rates be higher or lower in 6 months? The kinds of things that you're unfortunately forced to consume in so many places were not part of the discussion. And we focus on diversification, which is the third point, long-term fundamental drivers of return, and building the best portfolio we can. So we go to the next slide. So we actually did adopt a different mix about May of last year. So the current mix, which is really the current mix, was not changed this morning to get to the point. So the committee was very comfortable leaving the mix exactly where it is. So you can see 62% in stocks. Opportunistic is it's been a very weak performer in the last year. That's changing rapidly as we speak, I'm glad to say. But opportunistic is basically more niche, nuanced, concentrated strategies, and they're expected to deviate from benchmarks. We prefer they deviate above, not below them, but we know that they'll do both. And over time, we have a really great portfolio there, and it will continue to do what it used to do, which is perform very well and catch up for us quickly, I hope. But 62% in stocks, very diversified around the world and a variety of strategies. Only 12% in bonds. So interest rates are higher today. So we're interested in that. And the committee had a very long conversation about whether this was the right moment to increase the bond exposure because yields are higher. And the reason we didn't end up with that conclusion is our equity portfolio is just too compelling today. We cannot walk away from it. And the committee felt very comfortable with that the misvaluation of the portfolio we have is extraordinary. And I'll come back to the contrast between that and the index a little bit later. So we left the 12% where it is. And then the bottom piece was also left where it is. And I would just highlight the mission investments at 5%. It's actually one of our best performing asset classes last year, which is wonderful. And it's also a wonderful area for the portfolio and part of a very strong strategic mix. Those returns are always part of the overall pool returns. And so when we're talking about beating benchmarks and beating our peers, that's all very much in those numbers. So, two more things quickly on this page. The committee does review this annually, although they're not required to only talk about it annually. In fact, one of the things we talked about this morning is if the embedded value of the equity portfolio comes out quick, i.e. we get huge gains from here in the next 6 months or 9 months, the committee could choose to revisit this mix sooner because the bond portfolio we might want to make it a little bit bigger in that scenario. But we'll see what happens. That's a question of time. And the second thing is, thanks to Yelena and Ken and the team on the finance side, we keep the portfolio very close to these targets as much as we can. You will see, if you look at the detailed reports, that private assets are well above our target. That's because they've been so successful compared to public markets and also a variety of other factors, but we're expecting that to converge in the next few quarters or so. So we're not particularly worried about that overage there. So we go to the next slide. So one of the conversations the committee actually never has, which most people do have to have or should have, is why don't we just index the whole thing? And the reason we don't do that is because we had so much success outperforming the indexes over time. I would also tell you that if I was given a choice of indexes or actively managed portfolio, I'm not sure, I'd probably pick the index, by the way, but I'm given the choice of indexes or our actively managed portfolio here, and I will choose this portfolio. But even more importantly, if you gave me an index portfolio as my only option, I would have less stocks today than we have today. The bond stock question would not be nearly as difficult as this here because the indexes are not interesting today on a core basis. So how has the foundation succeeded in what's been referred to as the loser's game, correctly so, because it's very hard to exceed and outperform an active manager. So the first thing, which is not on this page, but I want to spend a second on it, is this investment committee again. Patience, even with disappointing short-term outcomes, as long as they're given good reasons for those outcomes and good reasons to think that the future will be different, that is an incredibly rare gift. Most people don't have it, frankly, and they won't have it, and they don't have the introspection to even understand they're missing it. But this committee, again, with all the changing in people, I can't believe it's worked out this well. I'm a little bit pessimistic usually, but this case has been incredible. So this committee is amazing. So those premiums you see come from not just hiring great managers, but being patient when they don't look like great managers. And that's a very, very complicated combination. But beyond that, the crucial team, our job is to go find these managers. So you have to start with the great managers. That's first and foremost. The committee wouldn't be so patient if they had less confidence in the process and the research being done. So 3 rules that we follow here. high bar. So we must expect large premiums to the benchmarks. We don't hire managers who can outperform by a little because it's not worth the risk and certainly not worth the fees. But if somebody can outperform by a very large margin, by large, I mean 2, 3, 4, 5% or more per year net of fees. That's what we were expecting from these managers. So somebody who's outperforming by, let's say, 0.4% per year net of fees and tells us they're happy with that outcome, well, we're not, and we'll move on. We'd rather own the index. Second point, people must have an edge. That's really important to think about. And I'll tell you, one of the problems with the way a lot of folks invest is they want to invest in things that they know, which is great. The problem is most of us don't really know anything that other people don't know. And so when something's comfortable and something's popular, that's usually not a very good sign. And so the edge here has to be that you're very specialized, you have a long horizon, you're able to avoid emotional reactions to disappointing outcomes. There's a whole bunch of different things that happen. And I can give you examples in the portfolio for those of you who are interested. And then last, we avoid the risks that you don't get paid to take. You don't get paid to be excessively levered or any leverage, frankly, for the most part. You don't get paid. I know excessive risk aversion sounds like a crazy term, but it's one of the ones we love, which means that you don't get paid for people who are constantly worrying about not losing any money in the short run. You can't be, for example, an equity investor and not lose money sometimes. And if you are overly focused on it, you tend to actually go to cash when things get bad. You do all kinds of crazy things that don't help the long term. And then destabilizing liquidity structures is kind of a complicated term. What it means in English is that the assets and the time horizon of the manager need to match up with the promised liquidity to the investors. So we think about all of these things. So we go to the next slide. The other part of this equation, which is extremely important, and it's a very simple concept, which is we always talk about the word diversification in investing. But there's another version of that word, which is diversity. And it's the same concept, which is we need people who look at the world very differently from one another. So if we're going to use active managers who are going to basically be shooting for very high returns, we know for a fact, and you can see it in our reports in 2022, that some of them are going to have disappointing short-term outcomes. That's just how it goes. And our goal is to moderate those outcomes on the overall portfolio. And one of the ways to do that is to have a very distinct group of decision makers in the portfolio. So diversification and diversity are one of the same. And the term that we use at Crucial a lot is something called variant perception. And variant perception in English means that I or you see something different than other people see. And when that happens in the markets, and the market's pricing something for an outcome that you think will be differently based on a lot of research, it may not be right, but you have a reason for your beliefs, that is an amazing opportunity. And we're more likely to get variant perception if we hire people who have different ethnicity, gender, age, and location in the world. So that's a big part of the equation, is putting all these different things that are contributors to variant perception into the portfolio. We don't need a whole bunch of people who all do the same thing, see things the same way, always agree on everything. Completely useless to us. So if we go to the next slide. This is the report card of diversification in this portfolio in terms of the diversity. So we're up to 23.4% of the assets are in the hands of diverse managers. The industry as a whole, and these numbers are debated a little bit, not in terms of degree, as little as 0.9%. I've seen as high as 2%. There's a lot of weird ways people calculate this stuff, but I think it's low is the point. But the industry as a whole is not much money. It's not in the hands of white men. And so this is a very different strategy. And I will just highlight for you the fact that the top line there, UltraView Capital, that is a new manager in the portfolio is just added. So therefore further boosting our strategy. And all we're doing is we're hiring incredibly talented people and letting them be themselves and do their jobs. And that's the good thing for us. So we'll go to the next slide. So let's switch to the markets a little bit. I have a little bit of a complicated message for you. And I'm going to start off by telling you my 2 hopes for today's meeting. When you walk away. So the first hope I have is that you will walk away saying, Greater Milwaukee Foundation, really does understand what they're doing. They have a really good strategy. Their long-term results have been fabulous. Their short-term and intermediate results actually, short-term has not been great, but intermediate has been pretty good too, top quartile. And they're going to keep doing that because they have a really solid strategy. So that's my first goal, is have a lot of confidence in what we're doing. I think it's well placed. Second goal is that from a personal perspective, you each walk away with a goal or a desire to be more diversified than you might be. I don't know your investment strategy, so I want to be really clear about what I'm asking of you. But one of the things that's been very disconcerting, in our opinion, is that a lot of people think investing is about how much or when should I go back into tech stocks? Or is the S&P 500 going to keep being the greatest place in the universe to invest, as it has been for about 10 to 12 years, by the way? And I'd love to have you walk away from this meeting today and say, I can still go back into tech stocks. I'm not telling you not to, but maybe I should buy, I don't know, a small cap value stock in the US. Maybe I should buy a European company. Maybe I should buy a Japanese business. Maybe I should buy an emerging markets index. And I don't say that because we're so sure of what will happen next. I say it because diversification by asset class and sub-asset class within equities has not been a good strategy for a long time. That doesn't mean it won't be in the future. And in fact, it might be for you the salvation of getting to better returns for the next 10 years, which is why we wrote at the top, there's been a radical shift in the investment climate. We put a question mark because I don't like to sound overly confident, but it sure feels like something big has happened out there. And that big thing is that we do have inflation. And the big thing is that central banks, including the US Federal Reserve, are now handling themselves a lot differently. And they're not about to go back to what they did before. It takes a long time for them to even consider it. So it's very important to think about that there's been this big shift that we can all point to, we can all understand. Second point. Markets are cyclical, so we'll talk about that in another second or two, but it's very dangerous to assume they're not. And so when you look back at the last 10 years and say, well, what worked really well for me, which is what most of us do when we assess investments, keep in mind that there's not just a small chance, but there's a very big chance that what worked for the last decade is what will not work for the next decade. So you need to think about how to change. That's back to my second hope for this call, is that you'll walk away saying, let me make sure that my portfolio isn't just filled with stuff that would have worked for the last 10 years. Maybe I have stuff that actually was smart, but didn't work well for the last 10 years, because those could be the things that lead you going forward. If you really, really want to boil down the GMF portfolio strategy here and the foundation strategy, this is what we do. We are attracted to things that aren't working. We make sure they're actually reasonable and solid and should work. And then we take advantage of the fact that people get overly pessimistic about things when they don't work for a while. Third point, and I hate to be, I'm really being Debbie Downer on this one, but the fact is that the S&P was down about 18% last year. That barely scratched the surface of its overvaluation. And I'm sorry to say that, but these indexes are top heavy with big companies like Apple and Amazon and Microsoft, et cetera. And these companies trade at extremely high prices. And that's okay, but it's very hard to get to a premium return from that. And it's very hard to ignore the fact that if something trades at a high price, there's not a lot of margin for error. So if something goes wrong, whether it be higher interest rates or conflict with China, you pick a whole long list of things, those companies are much more vulnerable than the cheaper ones are. And unfortunately, that's something people haven't had to deal with for a long time, but that's part of investing, and it really is important. So last but not least, markets change. I think I covered that. So we'll go to the next slide. So here's just a great picture from Baird, amongst all of us, amongst our favorite firms out there, great investors, great fat firm in general. But this is just a cool chart. So what you're looking at here are the last, I guess this is 5 tightening cycles for the Federal Reserve, all the way back to 1994. And what you see here is the horizontal scale at the bottom is how long it took for the interest rate increases you see on the vertical scale to happen. So the red line that you see, and this does not include the Fed rate increase of about 10 days or so ago, or 2 weeks ago. And that's the 2022 increases. And what you see here is not only has this been one of the largest increases in interest rates the Federal Reserve has pulled off in a long time, it was also one of the quickest. And keep in mind, look at that scale. That's only about 170, 180 days, whereas the most closely comparable set of increases was 2004. That took about 500 days. So this was very fast, very aggressive. A lot of reasons the Fed had to do that. I think they did the right thing, frankly. And at the end of the day, this is why markets were so brutal last year, and why, as many of you know, the bond market was not a place to save yourself. It was just almost as bad as the stock market. The good news is bonds have gotten more interesting because interest rates are now higher, as you know, and you can actually make money on your savings. We haven't been able to say that in a long time. So go to the next slide. Back to change. Something very subtle, people don't seem to be talking about very much, but I think they should. And this gets back to the point I was making earlier. So these are the returns of different stock markets and regions around the world. So the United States is the top line, Europe, Japan, China, and then EM is emerging markets, excluding China. So take all the other emerging markets, Central Europe, Eastern Europe, Latin America, some parts of Southeast Asia, et cetera. And what you're looking at, look at the far right-hand column first. So local currency, what that means in English is that, for example, in Japan, the market itself was down 4.5%, period. Now look at this column next to it, down 16.7. The difference between those two numbers is because the Japanese yen was very weak compared to the dollar. So when we report things in US dollars, which is what we always do for your portfolio in the pool here, of course, because we only care about dollars there, obviously. the fact that we only lost 4.5% in theory on the index in Japan is irrelevant. We lost 16.7% because the currency got weaker compared to the dollar, and we had that currency exposure. So that's why these US dollar returns are actually the only thing that really matters. However, take a look at that far right-hand column. A lot of people invest based on what we would argue is half the story. So for example, isn't it interesting that Europe significantly outperformed the United States in 2022, all of which, by the way, occurred after the invasion of the Ukraine by Russia. And someone, if you want to, in a chat or some other time, tell me why Europe looks or feels like a great place to invest, and you won't be able to. It's an extremely complicated place to invest. And they have a war going on, and their economies are always a little messy, needless to say. And then they have Brexit on top of that. So putting all that together, it's fascinating that that was one of the better performing markets in the world last year. And it also makes sense to us because those markets were already pricing very, very bad outcomes when all was said and done. So my point is that don't be so sure that a simple story will translate into the best returns. And I think that's a really important part of the message here. So we go to the next slide. This is a very complicated one. I'm going to make it very, very, hopefully more straightforward than it looks. This is a picture of currency valuation. And I'm sorry to torture you with this, but it's a very important concept. So when this blue bars or blue lines that you see or blue shaded areas are very low on the page, that means that the US dollar is very expensive. Now, a more intuitive way to think about this, and we call it purchasing power parity. The best way to think about it is something that I think it was The Economist did years ago called the Big Mac Index, which is what does a Big Mac cost you in different parts of the world? So if you were in Tokyo, a Big Mac should cost the same dollar that one does in the United States, et cetera, et cetera, et cetera. The issue here is the reason that line is so low, and it's as low as it's been since the mid 80s, is because a Big Mac in Tokyo is actually very cheap for us right now. I was actually there in September. You can buy a Big Mac there. I'm not really a Big Mac guy for the most part, but they are delicious. 50 cents on the dollar in Tokyo. I was in Rio about 3 weeks ago. You can get a Big Mac in Rio for like 33 cents on the dollar. So that tells you something about the valuation of our currency. And the reason this is important is we had in the pool, and maybe personally you should as well, we have exposure to some currencies outside the US. Most of the portfolio is in dollars, to be clear, but there's a percentage that's not. And this is back to Wayne Gretzky again. Look at the cycles on this page. They exist. And we can pretend that they don't, but they do. And it takes years sometimes for them to play out. But we actually know exactly where the puck is going in this case. That blue line has to come back up. It just does. Now, how long does it take? That's where Wayne Gretzky's got one on us because he always knew when the puck would get there. We have no idea when the puck's going to get here. But we know if you're going to send the puck that way, we want to be there to collect the benefits of that. And we're not going to be too cute. So we'll be there a little early. We'll look a little stupid in the short term. But in the long term, in the intermediate term, we're going to capture this premium of that cycle turning. And this is just a great picture of what markets look like, which is they go to extremes and then they change. And they don't usually typically give you any warning that they're going to change. So you can't outsmart them. So we try to be in the right places, and this gives us a big edge. So we go to the next slide. Here's our strategy looking forward. It's the same one we've used for actually ever since we started with the foundation, which is a long time ago. I think we're passing 26 years now. Point one, strict adherence to decisions that with a high probability of success. That's why we're not trying to guess what the market's going to do this year, because we don't think the probability of success is very high. But we do know that the dollar is going to weaken. We just don't know when. That's a very probable, likely outcome for us. The fact that, and Kristen identified this earlier, this portfolio of you all working together and creating a scaled portfolio, lots of dollars, gives us the ability to access really talented investments, be very diversified, and use the long time horizon and the wonderful investment committee to get the outcomes we want. And last but not least, we don't like the losses. You don't like the losses. It's amazing how fast you can make them back in the right climate. But we do accept the fact that we will trade off some short-term losses, short-lived, hopefully, in return for higher returns in the long term. And that's the premiums we're looking for. So I thank you for your attention today. And I see Joseph's back up on my screen. So I'm looking forward to answering any questions that you might have.
Well, thanks, Mike. We have got a lot of questions for you today, so we'll just we'll move on into these. The first one has to do with the opportunistic special situation asset class as compared to emerging and international markets, which have performed far better, at least recently. So I think the question is asking you to sort of think a little bit or explain, why continue investing in opportunistic special situations and maybe there's other asset classes that are outperforming at this point?
Yeah, that's a great question. So obviously, with the benefit of hindsight, we should have had more in the other classes and less in the special situations. But what I would tell you is this, is one of the basic principles of diversification is that everything gets its turn. And so the emerging markets, for example, last year had a wonderful relative turn, although there have been many years where that wasn't the case. And hanging in there and waiting for their turn was really valuable. And that's really the simple operating procedure, which is, in our eyes, actually, believe it or not, you'll think I'm a little crazy when I say the following, but the special situations opportunistic is actually the highest returning public equity strategy in the portfolio. Now, when you look at the numbers, you say that's ridiculous. That's not true. But I'm telling you, on a long-term basis and a go-forward basis, it's the highest returner. And so that's why when it struggles in the short term, we're just waiting for its turn. And that's why we're so focused, and the committee is too, by the way, on ensuring that the actual things we're doing will live up to it having a turn and having that turn be meaningful. So again, it's a question of patience. It's a question of actually trying to look ahead, which is hard to do because the numbers are the numbers, and we're not pretending they don't mean anything. But that's the issue: is diversification is about giving everybody their chance, essentially, and being there when their turn comes. And the challenge is, back to Gretzky one more time, sorry, we just don't actually know when the special situations puck is going to arrive, but we know it's going to, and we're going to be there when it happens.
Great, thanks. We've got a bunch of questions around international investments. One person asking about Europe and European markets and sort of what you're thinking there. And then another question just about overseas investing being messy and sort of where are you finding bright spots or opportunities?
Yeah, great question. So it's very interesting to think about places like Europe. So first of all, if anybody starts the discussion around investing globally with, I think Europe is a better investment climate than the US, you'd have to just wonder what they're thinking. It's not. Let's be clear that Europe is a very messy economic place. It's a wonderful place to visit, but it's very messy economically. It's got a war going on, like we talked about, and a war that doesn't seem anywhere near ending, by the way. So a whole bunch of terrible things going on. So why would you invest there? And the answer is there's a couple of interesting factors. One is that markets do a weird thing, which is they price businesses based on where they're located and not where their businesses are. So the simple example is, let's talk about Boeing and Airbus. So Boeing, of course, is a US company. Airbus is a French company. But they're the same exact business, right? They're a duopoly that sells aircraft. There's no difference. And frankly, what happens in France doesn't affect Airbus any more, other than maybe labor issues, than what happens in France having an impact on Boeing. So there's an arbitrage there, which is you can sometimes buy the same quality business or better for a lower price because it happens to be in Europe. It's just one of those weird things. I've never understood why it's there, but it's there. That's the first one. So there's the fact that European companies can be global businesses is the point I'm really trying to make here, which is that it's not just a bet on the European economy, because it's certainly not that. The second thing is that's very interesting about investing in places like Europe and elsewhere outside the US is that it's just a simple concept of expand the opportunity set. Let's not just look at the big US companies. There are some big European companies that are actually very good businesses. One of the most valuable ones in the world is LVMH today. It's a very valuable company, sells a lot of stuff. I don't personally own any of their stuff, but I bet you some of you do. And so it's a great business. And so the point is, let's look everywhere we can to find great investments. So separate the macro and the stuff you read from what the investment opportunity set looks like. I think that's really, really important. And that's how I would think about that. In terms of where the opportunities are, so I want to be careful here. We don't think that a country or a place is in and of itself interesting other than the US. Instead, we think that a manager who buys 20 businesses in that place can find 20 great businesses. And so we're finding opportunities literally everywhere: Europe, Japan. I will tell you the place, and we don't have that much exposure where we do, it's very targeted. The place that's the most complicated today, though, is China, mainly because obviously they're going through some extremely complicated stuff. And, when you don't have a democracy and you don't have obviously pure capitalism by any means, you have to think about the implications as investors. And that's why we never quite jumped on the let's have tons of China exposure bandwagon that some endowments and foundations did. So that's the one place I'd probably be just very careful about. It's not a no-go zone per se, but it's a very complicated place. You have to be more thoughtful about the risks you're taking there than you might be in other places.
A related question, can you share what percentage of the portfolio is in non-US dollars?
I'm going to do this from memory, so because I can't bring up the screen, but I think it's about 25% of it's in non-US dollars. And if that needs to be corrected, we'll correct the record. But I think it's in that neighborhood.
Great, thanks. A question about inflation. The person is saying that inflation has cooled slightly, but not enough to please the Fed. I guess, what are you thinking that they're looking for, or what might you anticipate happening next?
Yeah. And again, I'm sorry to challenge the conventional wisdom that I guess we'd like to all believe. So yeah, inflation is cooling. And actually, when you look at some of the underlying drivers in inflation, they're definitely cooling. So there is some good news there. On the two-sided coin side of the equation, though, just to give you a second point that makes this a very interesting discussion, I'll get to your question, I promise. Labor costs are not cooling. Now, let's be clear here. One person's pain is another person's gain. So higher labor costs sounds like more wages for the average person in this country. That doesn't sound that terrible, right? But it's not so great if you like your profit margins in S&P 500 companies to be very high. So it's a complicated part of the equation. Again, with the societal impact not being so necessarily, it sounds pretty positive to me, but everyone has their own opinion on how that should work out. With all that said, that's a very persistent part of the inflation equation, which is why low unemployment in the United States and globally, but I'll give you a fun statistic I heard this morning. France has the lowest unemployment rate they have had since 2008 right now. And so this phenomena of labor capital imbalance is very significant, it's very global. So here's the thing, back to the question, what's going to make the Fed happy? The answer is, it's going to take a lot. And here's the problem. It's not about what the rate gets to in the short term, because there is this, I'm going to stick my neck out. We're not economists, but I'm going to do it anyway. There's this fantasy that inflation is going to drop to some level that the Fed's going to say, okay, good, we've solved the problem. We're going to now cut rates and we're going to go back to the party of 2019 and late 2020. The problem with that is that that's missing the key point, which is that the Fed learned a lesson in the 1970s, which was that you can't take your foot off the brake too quickly. The reason the 70s were a terrible inflationary climate wasn't because the Fed couldn't stop inflation. They did. They stopped it twice. The problem is that every time they stopped it, they said, oh, okay, this is fine. And they went back and they took the pressure off. And when the pressure came off, inflation popped back up. The Fed has been very clear. They understand that's what happened. And this Federal Reserve, I think, we could be wrong about this, but they're not going to make that mistake again, which is why if you're waiting for rates to be cut, I think you don't hold your breath. It's going to take a long time. And I think you'd have to be very patient and again, accept the fact that the climate has changed. So I'm sorry to I feel like I'm being very pessimistic today, but there you go.
Great. I think we have time for two more questions, and I'm going to save the fun one for the last question here. Can you talk about how staying the course and enduring short-term pain, which you referred to earlier, really contributes to that long-term success? Maybe an example or two, if you can think of one.
Yeah, and I'm gonna give you an answer. I'm also gonna make myself a note to make sure we put a slide in next time, which I think you guys will feel really fun. So whoever asked that question, others who are interested in getting a more robust answer I'm about to give, stay tuned next time, please. So the reason we say that, and what we mean in English, is that when things start to head south, we're not receding, we're not pulling back. We're actually adding capital to our weakest performing managers sometimes, again, with a lot of careful checking first, to our weakest asset classes. So we're essentially keeping our risk profile on, even when it seems like, this could go on a while because we just have no idea how long things will last. So that's what we mean by taking the pain, which is not trying to cut off the loss, not trying to prevent another loss. And the reason we do that is because the rebounds are stunning, and they're stunning because they happen quickly and without warning, and they wipe out the losses more quickly than people will realize. So the cool chart I'm going to show you next time is we've actually looked back at every 10% or more loss that this portfolio has had since the 1990s. And the forward 12-month return from those losses is usually a very big double-digit gain. And that's the gain by taking the pain. And when you put those things together, you have a positive return. So the drawdowns that we see, like these losses, they get recovered. But it's important that we make those recoveries happen as quickly as possible. And the way we do that is by not being tempted into protecting the portfolio from further losses.
So last question, you had mentioned sampling some international Big Macs, and the person is wondering from your worldly travels if you've got a favorite Big Mac. What's your favorite country?
Oh, Oh, okay. I hate to pick any one of them because they're all so wonderful, but I will tell you, I have just a weird love of Japan. I love Japan. I can't even tell you how much I love Japan. It's just a very interesting country. It's a beautiful country. It's a mess, but it's and a great investment community too. So I love Japan. So that's my favorite country in the world. But there are a lot more to choose from. So, but thanks. That was a great question.
Well, good. Well, thanks again, Mike, and thanks to everyone for your questions today. If you have other questions following the investor briefing today, we certainly invite you to reach out to your contact at the GMF by phone or email. And all of our staff here at the foundation can be of assistance as well. And as always, we're grateful for your partnership as we together work to make our community a stronger and a more thriving place for everyone who chooses to call Milwaukee home. So to close this out this afternoon, it's my pleasure to introduce Ken Robertson, who serves as our Executive Vice President, Chief Operating Officer, and Chief Financial Officer. So thanks again, Mike. Thanks again to all of you who joined us today. And Ken, please take it away.
Good morning, everyone, and thank you, Joseph and Michael and Kristen, and everyone for joining us today. Trusting everyone had a fantastic holiday. The Greater Milwaukee Foundation is full speed ahead as we look forward to some fantastic things in 2023. We're building on some significant progress made on the seeds that we planted in 2022. Lots of things to update you in the upcoming quarter. Today, I want to talk to you a little bit about our impact investing program. The foundation embarked on this journey about 7 years ago as a pilot. The goal of the pilot was to begin a program that could help remove some of the existing barriers in providing capital to women and people of color. We believed that if we could demonstrate impact and provide support, we could add another tool to our toolbox and leverage our assets in a way that could provide greater scale to get to our ultimate goal of economic empowerment. Fast forward 7 years, and we've built a program that we've deployed roughly $18 million. We're sustaining businesses, creating jobs, creating wealth, all while recirculating our investments in the community to achieve greater impact. Our impact investing program can be divided into two major categories. Our program-related investments that are funded primarily by both donor and discretionary funds are maintained in a pool primarily aimed at generating social returns, but there's also the expectation of some return generated and the return of capital. The product is generally low-cost loans. The other product or the other category is our mission-related investments, which is maintained as a separate asset class in our corporate pool. That is certainly mission-aligned, but there's an expectation that these products will generate a market return. In 2022, our mission-related investments was one of really only a few asset classes that actually generated a positive return. And we believe this asset class is a great complement to some of our traditional financial instruments. We're in great company in this space with Boston Foundation, the Kellogg Foundation, San Francisco, and many others. Really, today's foundations of all types and sizes make mission investments in order to make capital more available to initiatives and enterprises that will create positive benefits for the community that we serve. I'm happy to report to date that through stewardship, tutoring, and some great underwriting, that although we've intentionally leaned into a greater risk area, we've not written off a single investment. We believe that we're in the right space for us, and we invite others to join us on this journey as we seek to add more balance to this capital allocation challenge. So I want to thank you again for your interest in impact investing and your continued support. And please don't hesitate to call me at the foundation if you need additional information. Have a fantastic day.